We are looking at NASDAQ here. At 10 a.m., we have the revised consumer sentiment data. So it's a medium impact driver. This morning, we had core durable goods orders that gave us a little bit of a pre-market rally. Back up into new week opening gap, and then it went a little bit higher than that, obviously. Now, I want to take you over to 15-minute chart real quick. I mentioned the other day on Twitter, we had this big drop down here on Wednesday. So Thursday, I tried to calibrate your attention and focus on looking at the relative equal highs. We have relative equal highs here. We just cleared those. We have these two here and this one here. So I like the idea of getting up to 680. It may use the data at 10 o'clock to go through that. We've been fighting the impulsive nature that most traders want to pick the tops in bull markets. I know I tried to do that. Technically, I was afraid that a high was forming when I first started trading. That would usually keep me from taking trades when I was first starting out, thinking it couldn't go any higher. Because it's an election year, we're looking for reasons to see the price go higher. And because it's an election year, they're going to pump up the stock market. What we're watching for is what we get at 10 o'clock. Okay, so the first 5 or 10 minutes, worst case scenario, 15 minutes, we'll see what we get in regards to price delivery. I would not want to take a silver bullet trade until after a few minutes because they use these types of data points to mask their real intentions. We'll be studying these two price levels here. And again, keep your focus on the things that were smooth and left remaining above the marketplace after we had Thursday's decline. You know the protocol. If you're very, very new in trading, you want to try to stay away from the morning session after a large range day. I get the question a lot, what constitutes a large range day? How do we determine what that is? What is it measured against? What makes it a large range day? Well, if you look at what we have in Thursday, look how much larger this is in relationship to the last several days. I like the last 3 days, and it's usually a repeating theme in my concepts. Whatever the range average is over the last 3 days, if it's larger than that, then we're outside of the normal 3-day range. You can have a large expansion day inside those last 3 days, and it may skew the data. But over time, when you start to see the 3-day average start to compress and go smaller and smaller and smaller, and one of the things that is a precursor to large ranges is an inside day. An inside day is what we have here. Here's Thursday's range, but now notice also Thursday's range is inside of Wednesday's range, which is here. You can see we cleared that initial buy side there. But real quick, let me get into here's Wednesday's trading, the high of Wednesday and the low of Wednesday. And then Thursday, we had this smaller little range inside of it. So this is referred to as an inside day. So on Thursday, I talked about how your focus should be on where the things are left smooth. It's a relative equal highs. But if you want to use how I use it, I look over the last 3 days, and when ranges start to compress below the average of the last 3 days, so I know I have a large range candidate forming. But after a large range day, I've taught you that you want to try to avoid the morning session. But the 15-minute time frame, we can see how we had Thursday's drop down. Retail was all over just thinking, okay, we've topped, it's over, the market's going to go in, bears are in control, all that type of rhetoric. And then we had this really, really difficult morning session. We didn't have sustained price runs, back and forth, a lot of scribbling, very, very fuzzy. This is what I refer to as fuzzy price action. And the only reason why I came up with that term is because I was trying to teach my kids younger, and it just stuck. This high here is a little bit higher than that one, but nonetheless, my focus has been here. And on Thursday, I was prompting you to go back through your charts and look at anything that was relatively smooth in terms of highs. And let's jump into a 1-minute chart. And you can see how we use the consequent encouragement of the new week opening gap right there perfectly. So here's our run on those buy stops. And now we'll sit and wait for a few minutes and see what it wants to do. Now we have a huge gap. So if you look at the regular trading hours rating here, this is beautiful. That's my favorite type of range amount for gap ideas. But because we have Friday, because we have had a disruption on Wednesday where it traded and made the low of the week, then we had Thursday inside day, then we have what? We have a candidate for Friday being a large range day, with my prompting on Thursday saying that your focus shouldn't be on going lower because we already had the sell-off. Retail's already expecting all that. They're going to use Friday to do their run on unfinished business. Unfinished business is the orders up above the 659 and a quarter and the 680 level. Both levels of buy side have been engaged now. I'm not suggesting that it would want to come all the way back down into the gap. This is a day where I would say this is probably going to be a day where we leave the gap intact and not even try to go back to it. It can have a retracement, but because we're in a primary bull market, we're in an election year, and we're just literally less than 2 weeks away from the election, the probabilities of it going back down to that gap based on what we're seeing here is not as high as it would be if it were like in this area here. And whenever you have a opening gap like this on a Friday after a large range day, then created a subsequent on Thursday smaller range day, all based on the daily chart, that compression, that small tightening up, it's kind of like a spring and twisting it tighter and tighter and tighter until you can't compress it anymore. And then when you let go of it, bouncing all over the place and it's moving around a lot. That's what small range days or inside days create. That probability that you're going to get a large range day. Now, a large range day has the benefit of having very repeating characteristics. And now imagine we had the Thursday small range on the daily chart, and this is hypothetically a daily candlestick. And then you have Thursday's small range day, and then Wednesday's larger range. Okay, so we have Wednesday's daily candlestick, then Thursday's smaller, which is higher low than Wednesday's, and lower high than Wednesday's. And then we have Thursday closing with a small range day, and then Friday we have all this buy side up here that has not been engaged. After Thursday's went lower, smashed everybody's expectation of continuation. Now everybody is tricked into thinking the market's going to go lower. Because we have the probabilities of seeing a Friday's large range day, we solved the issue of direction because of my prompting on Thursday telling you to look at where everything is left in your charts where they're smooth, relative equal highs. But for Friday, because we're expecting the large range day expansion to occur, the direction is solved by looking where is the market leaving smooth highs or smooth lows. Well, we had Wednesday's drop down, that shift in sentiment, that means retail's looking for lower prices, go back to and revert back to a higher time frame macro perspective, which is it's an election year. So they're going to keep trying to push this monkey higher on the tree. And then what happens after November 5th, who knows? But here, the idea is that the large range day will usually occur after the small inside day. Whenever there's a small inside day, it's either the very next day or worst case scenario, the second day after. Well, you can't do that here on Friday because we don't trade on Saturday. So what are they going to do? They're going to rush right at the opening bell. And you see that happening here. The open is the low of the day thus far. So what are they doing? They're rushing to get the market up here. Who is they? The algorithm. It's running really, really quick to get to that level here because it doesn't want to offer the opportunity for individuals that have their stops up there that have been holding short, looking for Wednesday's continuation on Thursday, but didn't happen. And then Friday, here it is. They run real quick for them. That sudden one directional run is going after that liquidity. So they can't pull their orders. The direction is going to be bullish. One of the things I learned from Larry Williams is on large range days, if it's bullish, the open is going to be very, very low on the daily range. I know that it's going to be in the lower quarter of whatever the daily range would be. Let's do some math on that. If we know we're opening at 9:30, I look at sessions the same way I would look at a daily candlestick. For me, the morning session, the high and the low, where we start and where we stop, I look at it in this perspective. This is power 3. So I'm looking for the opening when I'm bullish, and I want to see manipulation. That's the drop down, because if I'm bullish, I want to see some opposing direction. That's the Judas swing. That's manipulation. And then the accumulation below the opening price or just above it, when it comes back down and touch it again, it does not need to come back and touch it. But if it does, that's all part of the accumulation phase. And then you have the profit release portion of the run. Then you go to the target, which would be the liquidity or some higher time frame PD array. That's these two levels here. So the market trades up into them. The open's going to be near the low of the day. It's actually the low of the day here if we're looking at the morning session. But if you look at it through the lens of overnight and at midnight, there's midnight. It creates the opening here. There's your opening price. Here's the low of the day right there. This line right here, think about this open, high, low, and close bar. That opening price is this. This drop down is this little tail that's making the low of the day. And then the market trades higher. It doesn't always, but it can come back and use that same opening price. What is it doing there? Trading right to that opening price. Hits it. Then it consolidates. What's it doing? It's accumulating all around that opening price. It creates the first drop down. That's where smart money is going to buy. The point is when you have a large range day expected, Larry brought a really amazing observation that I didn't notice. I never noticed that the opening would be near the low of bullish days. It was just completely... I didn't know about it. As a day trader, that's a superpower. Like one of the wonderful advantages, if you're a short-term trader or a day trader, you want to try to focus in on days when it's likely to start a price run like this, where everything is in your favor, that it's going to go one direction, find the opening price at midnight, and then anything below that price as it drops down, if it agrees with other factors that would constitute a trade, you have a high probability that you're going to be entering below the opening price, where and when smart money would accumulate their long positions. And just know, if we have an economic counter like we had this morning, we had 8:30, we had core durable goods orders, but then we had another news driver at 10 o'clock. So we had a split. Notice that? We had 8:30 news, and then we had 10 o'clock news. So you got to be real careful on days that have that split news delivery, because sometimes it can create like a whiplash where it sends the market one direction. The algorithm will use that data and trip traders up, and they'll use the first set of data at 8:30, kind of like a FOMC where the first run is the fake run, and then at 2:30 during the conference at FOMC, the real run takes place, and it's much larger in the opposite direction. Sometimes when you have split delivery on the economic calendar, 8:30 and 10 o'clock news like that, it can create those scenarios. But you can filter that out on days and circumstances like today, where we had the bias was bullish. When we're looking for the last trading day of the week to go for that target or these targets that we had outlined here, that means that they're going to use the opening bell. And even though there might be a large gap here, even though that there's a 70% likelihood that it trades the mid gap, these are the circumstances and these are the types of days where it's going to say not today. So it's in a hurry. It's a rush to get up here and get to that liquidity. What I'm suggesting to you is this. If you were aware of these types of things, if we knew that the 10:30 to 11:30 hour, that usually creates the intermediate term higher low of the morning session. And then it invite the lunch macro to define where the order flow is going to be during that 2-hour period between 11:30 to 1:30. The way that would unfold here is, let's just say, play devil's advocate for a moment. But at 10:30, let's say it is 10:30 right now. What would happen is the algorithm will computate the range high and the range low. And then it'll define where midpoint is or equilibrium. And then below that equilibrium price point at 10:30, then it'll start looking for sell side. And the lunch macro is always going to run on those that are profitable. That's what it does. So sometimes it'll go down and just take the first pool of liquidity, and then it'll consolidate in the rest of the day and go no lower and make no new high. Other instances where it'll trade down, trade into the trailed stop losses, and then once it triggers that sell side, then it'll accumulate and start running higher and keep going in the rest of the day into the last portion of the day and close the week out strong on its high. I believe that that is likely to occur today, meaning that if we stop, say you were a session trader, there's nothing wrong with you being done for the day if you were already long and you've traded up to here. Or if you took profits early and you weren't able to see this or weren't aware of it. If you are in a flat position right now or you haven't taken a trade, this is a wonderful instance where you can sit still and say, you know what, I'm content for this week. I'm done. Go back into that midnight on Friday. We're looking at what? The market consolidating. It's part of a larger consolidation, but it's during a period of time when the market's likely to trade higher. If we're looking for that range expansion, because Thursday was an inside day, our bias is determined bullish. We're expecting 2 news drivers at 8:30 and at 10 o'clock. So we have split delivery on the calendar. Normally, that would create a back and forth, and then after the 10 o'clock news is released, then the real price runs for the daily candlestick range is delivered. Not today, because it's the last trading day of the week. We have unfinished business up here to draw on that liquidity. By looking at that, at midnight, opening price, drop down, it trades back above it, trades back down into the opening price, here, rallies, accumulates, 3 a.m. What time is 3 a.m.? That's the heart of London session. So we would expect the market to create some kind of a displacement. Does it rally higher? Yes. Does it go above a short-term high? Yes. Then the market drops back down. What is it trading back down into? An order block? Does it take the low out? No. Does it rally again? Yes. Volume imbalance, inefficiency, inversion, fair value gap. All of that's being clustered all in that same area right there. Consolidation. And then finally at 3:30, runs higher to 4 o'clock in the morning. Trades all the way back down into the middle of the consolidation in here. What are we looking for? Higher prices. So anytime the market trades back down into a discount, PD array, mid-range or equilibrium like we see here. But if you're looking at how price delivers continuously higher, and then at 7 o'clock in the morning, we have the AM session starting. What do we have here? Smooth highs. So what's resting above that? Buy side. Market rallies up, trades up to and through, and then comes back down into this inefficiency here. If it's 2 inefficiencies, this is the one you want to try to trade in, but your stop has to respect the second fair value gap. So you can see it drops down into it here, but then still goes higher. Volume imbalance plus buy side imbalance, sell side inefficiency. That's a nice PD array. Confluence in agreement to 2 PD arrays and a discount. Trades down to here, rallies once more. And then this is 15 second. I was defining the range there, which I have to go out to do that here. All right, let's just say that you wanted to be a part of this move and you wanted to be a part of it over daily range. But you know, because of the circumstances and the things that are germane to today, being Friday, last trading day of the week, unfinished business, that big pool of liquidity above on the 15-minute time frame, these price levels here. Because that is the likely draw, but because we know that the likelihood of a large range day is going to form today on Friday, because we had a small inside day on Thursday, whenever that occurs, you have the indication that there's going to be a explosive large range one directional move. When it happens, it's going to most likely deliver in the basis of a low resistance liquidity run condition. That means it's not going to be a lot of fuzzy price action. Not going to be like it was yesterday on Thursday. Think about what Thursday really did. It created a small inside day relative to Wednesday's daily high and low. And because it's creating that small range day, it's not surprising to see how it was very back and forth. Even though it was tradable and I got beat up on the first 2 trades I tried, the next 2 fixed it because I stayed with my narrative. I didn't abandon my model because I had 2 losing trades in front of my students. I'm never going to look at the market any other way. I'm also a realist because I know I'll mess it up. And I did. I messed it up yesterday. My models don't fail. I fail using them because I try to do things when I've even told you not to do. Don't try to trade the morning session because why? The approach to trying to force precision in days like when we have a large range day on Wednesday where it's a big down day. The following morning session, you want to avoid that because it's going to evade you when it comes to precision. Study intraday price action on Thursday, and you'll see a lot of back and forth, the overlapping of the ranges. Once it creates a run, it comes right back over top of it. That is high resistance liquidity run conditions. That means that you're going to get chewed up, spat out. You're going to either blow your account, go into severe drawdown, or full tilt and be afraid to do anything the rest of the day. And because that happened to you yesterday, you're going to be fearful of taking the trades when it's like it is today, when it was low resistance liquidity run, where you don't have a whole lot of give and take and back and forth. It's just find me a PD array, get in it, go. What I defined in here, if you look at the high there, that high is this rotation and then start to move all the way back down into this area in here. So what I identified is the body for the first high here, and this was like a stop hunt. So I ignored that. So I'm looking at this reference point here as the low, and it comes back down and hits it here. So pre-market, that means before 9:30's opening bell, 10 minutes after 8, okay, you're in a macro. So what's it going to do? It's going to spool, trading all the way back down to the low over here. If we can define that range, okay, once we have that, we can calibrate that to whatever the high and the low is at the time. Once it retraces back down to a discounted range and starts to move higher, what is it doing right there on that price run? It cleared this high. If you're really, really bullish, you can use this short-term high here. That's a shift in market structure. But here, this really nails the deal and says, okay, we've had 2 points of reference where market traded above a short-term high. And then it gravitates right back down into order block, buy side balance, sell side inefficiency, range high, range low. With those 2 reference points, and we're bullish, and we're expecting a large range day, and we're expecting that there's most likely not going to see, if we have a large opening range gap, we're not going to see much, if at all, of a retracement into the opening range gap, because it's going to be go, go, go. It's Friday, doesn't have a lot of time. It's got to run aggressively for that buy side liquidity in the 600. So because all those factors coming together like a perfect storm, it's beneficial for you to try to start looking for setups before 9:30. But there's always silver bullets. Every hour there's a silver bullet. The whole idea of looking for this repeating phenomenon is not enough. It's identifying where you're going to wreck yourself. So because we have Friday having a large range day likely, and the direction was given to you because we're focusing on buy side liquidity, Friday's going to start right out the gate real fast. We may not get a return back in the opening range gap at all. So that means trading pre-market. Whenever I think that the market's likely to create a very large range day, or if it's so one-sided directionally, there's the 2 caveats to it. I will many times elect to trade pre-market before 9:30 and not do anything as entries at all after the opening bell because I'm already positioned. I'm in there usually between 7 o'clock and 9 o'clock. I'm positioned and I'm holding. I probably have had multiple partials and I'm waiting to see the continuation and expansion through and blow-off move that occurs during the opening bell and the opening range of 9:30 to 10 o'clock. And then if 10 o'clock affords me a silver bullet that would allow me to do a longer term hold and convinces me that I should go through the entire lunch session and then see if I can pyramid during the lunch macro where it retraces, goes down into liquidity, I can add to that. Or if I've taken partials off, I can add them back plus more because I have unrealized profit behind me still because I've entered so early in the day before 9:30. It just gives you a whole different perspective on what we're doing with the daily range. It's not defined just because at 9:30 it opens up and there's a gap. There's a whole lot of other things going on before 9:30 opening bell. But not every session before 9:30 should be traded. Not every one of them should be like that. There's going to be a lot of times where the market doesn't do much at all pre-market. And then at 9:30, everything comes alive and everything is very easy to trade. But because all the things I talked about in this lecture this morning coming together and coalescing in one day, in one session, very limited time because the week's getting ready to close. Just a real big pool of liquidity above us. And the split delivery on the economic calendar, we have 8:30 and 10 o'clock news. And we were already likely to have a large range gap opening. So don't look for that opening range gap to fill. Wait for it to just rip and run to its unfinished business where the smooth areas are on your chart. So if we can define this range from the high down to that low, we can then look at the grading aspect. When I'm picking specific fair value gaps, or if I'm picking order blocks, or if I'm looking for any specific PD array, it's not simply because a down closed candle makes it an order block. It's not simply because there's a separation by one candle defining an exposed single delivery fair value gap that makes it a tradable fair value gap for me. You're looking for fair value gaps that match this. When you have a dealing range, and we define that from this high here, and it's dropping down back to a PD array over here. This was a stop run. So we nix this. We don't even pay attention to this candlestick. All that was a little bump, take that high, and then price went lower. It drops back down to a discount. I'm looking at this high here and the bodies, because this wick is just like this one. It's doing damage. I'm going to go back to the bodies here. And I showed you by drawing that out in time, that's the return to it here. And then we have a shift in market structure. You can define it with this high here. And there's nothing wrong with that in this case because we are expecting a large range day to deliver today on Friday because Thursday was an inside day. Using this one, it qualifies it even further because when it trades above this one, it's one candle and then the next candle trades above that high. So it shifts market structure bullish. So any retracement back down into this inefficiency here should be viewed as what? A discount array. Now, because this high is the highest high in this retracement, in a market that's bullish, we can grade that price swing. I do this with actual dealing ranges, as you see here, and I also do this in price runs where I either expect to enter or when I actually enter the trade and then where my target is. I know by doing what I'm about to show you here, I can predict where my future PD arrays are going to form. So here's your dealing range and equilibrium is the halfway point right here. Ideally, your best entries, lowest risk, highest yield is going to be entered on a long at or below this line. Pyramiding has to be limited to this price level here or lower. How can we use this information to pick the right fair value gaps and to pick the right order block? Here we have the upper and lower quadrants. Okay, and this is when you want to take a picture, you can see that these are my quadrant levels, optimal trade entry level here. This, when I need to pull up the OTE, I just change the 0.75 to 0.725. Or 0.79. And then the rest are extensions that it's using the opening range, gap, and standard deviation. It kind of picks the high and low of the day. What we're seeing here is the quadrant that is grading this dealing range from the high down to that low. Now think about it. Yesterday, I took your attention and told you to start focusing on the relative equal highs where everything was left smooth in the marketplace. That's our bias, is bullish. So that means we're going to be looking for draws on liquidity for buy side. We're not interested in short. So that means you're going to look for bullish order block. It means you're going to look for bullish breakers. It means you're going to look for bullish fair value gaps, or you're going to look for fair value gaps that were initially characterized as what would be short selling or premium that's going to be broken and then treated as an inversion fair value gap. You see how everything changes to, these are usable PD arrays. These are reference points that now you can suddenly build an idea or an expectation around versus every down close candle should be an order block. It's not. At 8:30, the algorithm kicks in whether there's news or not, but we had medium impact news driver this morning. So at 8:30, the market trades into our discount array, and then we wait for what? Displacement. We don't just go down here and start buying just because it's trading there. Let the algorithm tip its hand to you. Let the market say, listen, I'm going to show you what I'm about to do. Pay attention. So the market goes above the short-term high here. What makes this candlestick important? It's lower high here and it's lower high here. So that's a swing high. So when the market breaks above that, that's a shift in market structure. So we can see it as such. And then it displaces higher. And then we have another swing high. But there's a swing high there. It broke both of them, leaving what? This buy side imbalance, sell side inefficiency. A portion of the order block or a portion of the fair value gap must be at or below the quadrant level. Here's your lower quadrant level. Here's your fair value gap. Is this fair value gap at or below the lower quadrant? Yes. That means that this fair value gap is a proper candidate to be long when you're bullish. When time, 8:30, that's the only 30-minute delineator for a macro. 3:15 to 3:45 for the last hour trading. And then you have the first 10 minutes to the top of the hour and the first 10 minutes after the top of the hour. That's every hour macro. But 8:30, whether there's news or not, the algorithm will start spooling. If it doesn't start spooling and running, then you just simply wait because it's telling you that it's waiting for the 9:30 opening bell. If you're anticipating something here, it just meanders around or goes lower. Do nothing. Sit still and wait for the 9:30 opening bell. By defining this with the quadrant level here, your fair value gap or order block, which is this down close candle right there, is that below that quadrant level? Yes. Is this fair value gap at or less than this quadrant level of this dealing range? Yes. Now watch what happens. The market trades down. We have a little bit of a mohawk. That's fine because you have an order block there. That order block right here. Why am I specifically using that one? Because it has the lowest down close with a body. So the body's projection lower, it's lower, and we don't use this wick. This is your order block right there. Half of that order block is a mean threshold reference point. That price is 452.75. What's the low of that candlestick? 452.75. Folks, that's perfection. On the next candlestick right there, what's the candlestick low there? 20,452.75. So the market does what? It rallies back up, and look what it does. It delivers into this volume imbalance. See that? So this volume imbalance, it delivers it. What's it missing? Buy side and sell side delivery. So it buries a body inside that volume imbalance and then drops right back down into what? That swing high here. Rallies back up, leaves the lower quadrant, trades up to equilibrium, meanders around in here, and then causes another displacement. What is this candlestick right there? It's a fair value gap. Well, ICT, why didn't you use this one? Because where's that? The majority of the body of that buy side and balance side efficiency is what? Above that quadrant. Starting to make sense now, isn't it? Here we have what? Equilibrium. We're at that precipice where if you're building a position in all this down here, pyramiding, we're at that halfway point of that dealing range. So that means you have to do all of your business at that price range here or less if you're going to be pyramiding. Otherwise, if you start adding up in here or above it, you're really just tossing good money after potentially you might see a retracement. Even though it's low resistance liquidity runs, meaning that we're not getting a whole lot of deep retracements. What's a characteristic of low resistance liquidity runs? Down closed candles will support price higher, and inefficiencies will leave a portion open. I've already said it before, but you probably forgot. Every day when you first start your day, have that written down in front of you on your notepad. High resistance liquidity runs are going to see a lot of give and take back and forth, and every fair value gap will be closed in. Remember, if it's spending a lot of time in the inefficiencies, what is it doing? It's telling you we're inside of high resistance. That means it's going to be problematic for you. You're not going to be comfortable in it. It's going to be back and forth price action. Don't run your stop loss up real quick to break even. Just let it move or don't trade. So in here, we are in close proximity to equilibrium from the dealing range high, dealing range low. We've already accumulated down here, rallied up, equilibrium, retracement, and then displacement here. So we are seeing this fair value gap dead in the middle, consequent encroachment. We can now take that also. Because it's laying inside of equilibrium and half of that gap is basically overlapping that blue line, which is equilibrium of the dealing range. When you're bullish, how could you use that? Now, you can try to put a limit order to buy right at the midpoint, trusting that it's going to leave the lower portion open. Notice how it left this down here open? What is that? It's a breakaway gap. This is a tradable fair value gap. But because the consequent encroachment of this gap, which is this, watch, that's this line right here, it's overlapping with the equilibrium price point or middle of the high to that low. So it's a convergence of two factors of equilibrium or midpoint. So this is where a institutional order flow entry drill would be optimal, because you would expect what? Only a partial entry into that blue shaded area or fair value gap. This is institutional order flow entry drill, or you can use the upper quadrant of this range, and that would be done like this. And you would use that price plus one tick, 462 3/4 plus one tick. And that would be your entry. That would basically give you a very specific, not a zone entry, a very specific price level that would constitute an institutional order flow entry drill. An institutional order flow entry drill is a entry model where you're expecting a fair value gap to be traded into, but not fully closed in. And because you're expecting low resistance liquidity run conditions today, because of all the things I talked about in the first half of this lecture today, all those things building and coalescing with the idea that it's going to be a large range day, it's going to be explosive at the opening. Any opening range gap should not be expected to be traded to, even though there's a 70% likelihood that half the gap should be repriced to in the first 30 minutes. Throw that to the sidelines and expect them to just really make a mad dash to get to the liquidity that we've outlined. Low resistance liquidity run entries in here, low resistance liquidity run entries here. And then this is a gap that is what? Below the upper quadrant. And this is where I would use to see if I'm on side. You can take that and enter, right? There's nothing saying that you can't use that as a model. I'm not saying that I'm comfortable doing that. I could do it, but because I have to have principles and protocols and procedures to follow, because otherwise I'm left to my flesh, and my flesh will do like it did yesterday and put me in things that I shouldn't be doing. If you're listening to me, your trading ends on the entries here or less. Anything above it, you're just using it for management purposes. When this fair value gap forms, this is a valid fair value gap, but it should not fully close in. Why? Because we're in low resistance liquidity run conditions. We're in an early session of a potential large range day that's bullish, and we're at the upper quadrant and less. See that? So what does that create in here? This candlestick's low. That's an institutional order flow entry drill. That's an institutional order flow entry drill. That's an institutional order flow entry drill. Leaving what? Portion of the range open. That is telling you continuous feedback that yes, down closed candles consecutively, that's an order block. Draw that out in time. Hits it. Does it support price? Yes. In and of it by itself? Nope. Half of this gap at equilibrium and an order block, this portion should stay open. It should not trade back down to this one because that's a breakaway gap. All those things are signatures and characteristic of low resistance liquidity run. When you enter in here, your stop loss can be just below this candlestick's high, because it's not going to go down to the lower bottom of that fair value gap because we're in low resistance liquidity run. The algorithm is controlling this. So if you know what the mechanism is going to be when it is seeing these things based on defining your dealing range, knowing where equilibrium is, if you're bullish, you're buying at it or below it, in every fair value gap, or in this case, order block. Isn't this an order block? Down close candle, down close candle. 2 consecutive down close candles, that's all one range. It's delivering price lower. Does that down close candle support price going higher when it comes back down to it here? Yes. then price goes higher. Down close candles here, 1, 2, 3, and then it creates that final institutional order flow entry drill, like it did here in this range here, going right below the high of the fair value gap. Same thing here. This candlestick's low. That's the high of this blue shaded area where fair value gap. So it's trading back down into that. But isn't that also reaching into the order block supporting price? When we're seeing price trade down into it, this candlestick here, isn't that an order block? And then the down close candle when price is moving higher. Inside that candlestick's range, it's trading down into it. And it's rare that it does this, but sometimes it will. It'll trade to the low of the candlestick. I don't like that. I would never enter on a trade like that. I want to see half of a bullish order block, the mean threshold or higher, to its high. I want to see price use that portion of it to trade down into and then repel price away. When you're looking for dojis or tails beneath the candlestick, like we're seeing here and here, those are forming inside order blocks or inside fair value gaps. When the order flow is bullish, you can anticipate these things forming. That's why when you look at my entries, I'm always entering on the very lowest candle or the one candle before or the one candle after the lowest candle when I'm bullish. Don't take my word for it. Go back and look at every example I've showed when I'm executing with live data. And the market then leaves this range and breaks above the dealing range here. And then we're going into that 9 o'clock hour. And we trade up into new week opening gap here. 20,495. I mentioned that yesterday. That was my target, and it hit there. We traded up to just short of consequent encroachment of the new week opening gap. Now, this is current new week opening gap. Notice I don't have 1,000 different new week opening gaps. I don't have every new day opening gap on my chart. Some of you are leaving comments saying that I am so confused. I have all these lines in my chart because you're trying to put everything that's in the kitchen sink in front of you. And I don't do that. All you need is a draw on liquidity. That might be a session high. That means like a morning session or a PM session from the previous day, a London session high or low, an Asian session high or low. Wherever you think the market's going to gravitate to for the purposes of tapping in and engaging liquidity, where is it smooth? Where is there a single high? It isn't always relative equal highs and relative equal lows. That's just the easy things that a new student I've learned that it's very easy for them to spot that. Just like a fair value gap. You can see there's gaps. Now you know how I formulate an idea around the fair value gap that I want to trade on. Just because it's a gap doesn't mean that's the one I'm trading. Here is the consequent encroachment of the new week opening gap. Now, again, the new week opening gap is the difference between 4:59 closing price on Friday to 6 p.m. Sunday opening price. And then the difference between those two price points, the halfway point, is this little dotted line right here, which is consequent encroachment. So we see it fail to get to it initially here, and then it drops down outside of the new week opening gap. Does that mean it's going lower? No. Then the market rallies back up and trades to the high of the new week opening gap. And then now what do you want to see happen? Well, remember, we have all that liquidity up in the 600s. We still have some range to go. Look, we're in the 400 still. The market drops back down, stops dead in its track, and starts delivering price higher. And then ahead of 9:30, they run against those individuals that are on side. And all this movement here, even the model 2022 guys, we have a shift in market structure. There's a fair value gap right there. It trades all the way back up to a premium. And then it's also optimal trade entry. And look at this. It's selling off. Yeah, look at that. Beautiful. If you didn't take a partial, your ass is handed to you. It's just being delivered back to what price level? Consequent encroachment, consequent encroachment, consequent encroachment, and then at 9:30, all hell breaks loose. Boom! Manual intervention, because the hand says we're not letting those buy stops off the hook. You see this delivery stopping dead in its tracks on here. I didn't invent a gap opening on Sunday. I codified the concept of using that gap. We're on fucking Friday, folks. That was on Sunday. It's been trading around, up, down, through, and all that stuff. But the time it's using those levels with the narrative that it's likely to go higher, because the bias is bullish, because it's an election year and we're not trying to pick the top in a primary bull market. When you have these things come together, you have blue ribbon result. You have too good to be true type result. That's what I'm showing you examples on. I show you examples when I know everything that I teach you is in my favor. If I try to trade every fair value gap just because there's 3 candles in the chart and one of them single passes through between the two, and I use that as the entry model for going long or short without a bias, without the right time of day, if I'm doing it ahead of an economic calendar event that's going to probably be used as a smokescreen to move price around, am I going to be successful at that? Fuck no, I'm not going to be successful at that. No way. Nobody would. You have to have a draw on liquidity. You define that by liquidity above or below session highs and session lows. That means Asian session, PM session in New York, AM session in New York, the lunch hour in New York. That's 11:30 to 1:30. What's the highest high and the lowest low between those two reference points? That's what the lunch macro is going to identify and attack. Then you have the pre-market between 7 o'clock and 9 o'clock. What's the session high and low of that? Then you have the London session. Then you have Asian session. How many opportunities is that all in and of itself just for drawing liquidity. That's a lot. You're never running short on opportunities. But the opportunities to reach that liquidity, does it really match with what the economic calendar is affording you? The rundown into consequent encroachment ripping higher is all part of this larger range delivery that has been encapsulated around Thursday creating an inside day. So there's a compression, and then we know there's a large range expansion on Friday likely to happen, and you want to be pre-market entry and then let it go. And then it trades up into the pools of liquidity that we were looking for here. Gyrated around, came back down into a pool of liquidity here, relatively equal lows. You see that? Trades lower, rips, makes a higher high, and then we're just consolidating around that. Look how it's just meandering around. That's what I'm saying. If earlier in the beginning of the session, I said you would be done. If you're a morning session trader, if you're a day trader, you'd be done. If you're a position trader, a swing trader, you'd have 80% of your position off. And then see if it wants to continue going into the afternoon session. It may not. But at this point, if you haven't banked 80% of your run, you're doing it wrong. And that's how you use pre-market session when you're anticipating a large range day. How do you anticipate a large range day? By looking at the last 3 trading days, getting the average of the last 3 trading days. And if you are closing today less than that average daily range, that means that you are in a small range day. That's mathematically defining something that is very simple. Now, it's extremely sensitive, so I don't mind that because I have a little bit better perception on where the market's going to go and like bias. I know what I'm looking for. But if you want to break it down to 5 days average daily range, and if you start creating daily ranges that are less than the last 5 days, you are in close proximity to a large range expansion day. And large range expansion days are 90% low resistance liquidity runs. So a small range, if it's not a large day, then you're probably going to be met with high resistance liquidity runs. Not all the time, but 90% of the time, large range days are low resistance. That means there's very little give back. And you can see it here. It's just like off to the races it goes. And it's just like go, 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 go. Another characteristic when you're trying to trade in low resistance liquidity runs, don't be in such a rush to take partials off. Manage those days by your stop loss. Don't be in a hurry to just pay yourself because you're going to be like a deer in headlights. You're going to be scared because it's going to be running in your favor so fast. It's scary. If you've never made big money, if you've never been in a trade where it's just ripping and taking off and moving hundreds, not 10 handles, hundreds of handles in very short time, it's going to be very intimidating for you. If you know that you're in low resistance liquidity run days, move your stop to a reasonable level where you can just take a break and walk away from it. Have your limit orders in. If it hits your targets, you're done. But walk away from it. Go do something. Take a walk. Go work out for 20 to 30 minutes and then come back. And you'll be rewarded for having been in it a little bit longer. And you won't be watching, in this case, a 15-second chart. Every little fluctuation and minor movement is going to scare you out of the trade. It's going to make you feel like every little possible retracement is the top of the marketplace. And without having an idea where the market's gravitating to, by having that reference points of those liquidity, remember on the 15-minute time frame, that's these highs here. That's smooth right here. High, lower high, lower high. This is a prime candidate for a run on liquidity. You've been trained to look for that in price action. And look how this quickly ran right to it. But that speed, that element of speed is because of the day of the week phenomenon. They don't have a whole lot of time. They only have today until 5 p.m. Are they going to wait until the afternoon to get to there? No, they want to be done. They don't want people to sit there and think, oh, maybe I should square my positions going in the weekend because there might be something that happens in the Middle East and I wake up to gap risk on Sunday. They don't want that. So they intervene manually and boom, you get that. Doesn't this look like FOMC? Look how fast that ran like that. That's not algorithmic. That's intervention. That's what that is. There's a lot of things that you have to learn before you start going out there and trying to make money. There's a lot of things you have to learn that's going to prevent you from making said money. And I'm telling you, losing money sucks. And I have learned lessons that no other author, no other teacher, educator, and I bought thousands of shit, and none of them ever scratched the itch. They never gave me the things and the tools and the mindset to say, okay, I know how to buy into a bullish market. You all know how to do that. You know how to short in a bearish market. You know how to do that. But how do you manage your stop loss appropriately? Nobody fucking writes books on that. They just say, okay, trail it below the next swing high. Scale your risk and reduce it by moving your stop loss to the lower swing high when you're bearish and keep trailing it down. If you do that in high resistance liquidity runs, you're getting stopped out. If you lax and don't do that in low resistance liquidity runs, you're not going to get stopped out prematurely because the market's going to be allowed to move around a little bit. And it's less likely it's going to move to those levels anyway. How many lows did you see get retraced on in here? On a 15-minute time frame, 5-minute time frame, 1-minute time frame. Shit, look, it stopped dead in its tracks at consequent encroachment twice, here and here. It didn't take sell side. It's not interested in that. It's aiming for what? These suckers up here. They're pissed off right now. As we get closer to this election, probably going to see a lot of volatility. And if you've never studied price action on election night, that is a wild day. In the evening time, it creates creates this really wild spike up and down. They clear the board. I think it's going to be exaggerated this year. I think it's going to be an exaggeration, not just simply on election day. I think it'll go like that for a few days. And if they don't have the results, they're already building a narrative to expect that they won't know for weeks. And if you remember back when Gore and Bush presidency was done, it took weeks for them to come out and finally say that Bush was identified as the winner that time. There's a whole lot to expect in terms of tomfoolery. That means we're probably going to see a lot of volatility. And my advice to you, gear down in your leverage. If anybody's telling you trade big right now, they're an absolute fucking moron. Nobody fucking knows what we're going to see in a couple weeks. But I know it's going to be a shitstorm. That means that risk is going to go through the roof. And instead of trading 15 contracts, I'm trading one, just one. But I'm no good in a market where they're just going to go in there and mop the floor with everybody. And I expect that. There is a perfect stage being presented over the next couple of weeks where the level of manual intervention is going to be astronomical. I hope I'm wrong, and I hope it's smooth trading and there's lots of really good low resistance liquidity run. It would be disingenuous of me as a educator and mentor with your well-being in my mind for me not to remind you that you should dial back your risk. What happens if you make a lot of money and you're over leveraged? You're not going to stop there. You're going to take another trade, do the same thing, and you may not get the same result, and it may be worse, and it may end you. If you just take one contract or trade in micros, this is not a once-in-a-lifetime opportunity. It's going to seem like that, and everybody's going to sell it like that because they're gambling. It's easy to sell your ideas to yourself and think, what if it does this in my favor? Now, poker, I'll admit that takes a little bit of skill. But pulling a fucking slot machine down, that is no skill. But everybody that comes into the marketplace and they think they're just going to over leverage and get these big moves and not have any hardship, just listen to me, okay? Your career is not encapsulated in the next couple weeks, but you can end it in the next couple weeks. The lasting impressions of damage that's caused by over leveraging and conditions that we're about to experience, you can't fully appreciate that. I have lots of that stuff from the 90s in me still. And you don't have the 30 years experience that I have. So how do you think it's going to affect you as a new trader? It's going to be much more impactful. Adversely, it's not going to help you. It's going to make it harder for you to execute because you're going to be now thinking about fear when fear shouldn't be any factor in your trading. Respect the risk, but not fear it.